AM Best has released a new special report exploring total return reinsurers and how market dynamics can impact them. It's been largely a mixed bag for these companies so far, and here to discuss their results are AM Best financial analyst Dan Hofmeister and director Steve Chirico. So Steve, what does it mean to be a total return reinsurer? And is that the same thing as a hedge fund reinsurer?
Well, Meg, I'll start with your second question first. A hedge fund reinsurer is a subset of what we would term a total return reinsurer. The use of hedge funds as alternative assets is only part of the alternative assets available to a total return company. Other types of investments could be private equity funds, real estate, derivatives exposure, and other things. So we like to think about hedge fund re as a subset of total return reinsurer. Your first question is, what exactly is it? And that's where a nuance comes in. There are plenty of insurance companies and reinsurers that deploy some amount of risky assets in their investment portfolio in the hope to maximize the total return of the enterprise. The difference is a total return reinsurer is actively taking risk on both sides of the balance sheet and managing the leverage, the investment leverage on the asset side of the balance sheet, of course, and the premium and reserve leverage on the liability side of the balance sheet in an effort to maximize total return. The difference is that, and we'll dive into this, but you'll see, and the report goes into it in quite a bit of detail, the hedge fund REIs, the total return reinsurers, tend to be somewhat less levered on the operational side, on the liability side of the balance sheet, and more levered, of course, on the asset side. And so how the entity is managed is what dictates how AM Best thinks of a total return reinsurer, as opposed to just a traditional reinsurer that employs 5 or 10 or 15 or 20% of their assets in risky assets.
So Dan, compared to a traditional reinsurer, what value add does a total return reinsurer bring?
I think the obvious answer here is the investment acumen of the investment managers themselves. We see a lot of good investment managers across the reinsurance industry, but there is some conservatism across the industry in how they allocate that capital. I think these investment managers are going to bring some more dynamic strategies, some more hedge fund type strategies that we've seen in other markets. And I think that's something that you don't get quite the exposure to in the traditional reinsurance sector.
So Dan, maybe in addition to that, the theoretical advantage is that you can seek return and bear risk on both sides of the balance sheet. And you have the ability to diversify your earnings stream between investments and reinsurance. Those things have been proven to be somewhat complementary, particularly in property cat and other types of exposures that don't have a lot of correlation to the investment markets. And additionally, the theoretical advantage is that in a soft pricing cycle in reinsurance, they can deploy, these types of entities can deploy more capital on the asset side of the equation, taking more risk and seeking more return on the asset side. And conversely, when the investment markets are anemic and the reinsurance market pricing is hardening, you can reverse that allocation. And we're really at the cusp of that transaction at this point. Starting in 2018, there was an extreme amount of volatility that was introduced to the investment markets that we hadn't seen in quite a while, really since 2012 or before. And what that was correlated with at the exact same time was some reinsurance hardening that was happening because of some of the property cat activity that happened starting in 2017. That's been exacerbated by continuing natural property cat events. And now, of course, in 2020, the COVID implications and the economic implications of the COVID virus. So you can imagine if you have both sides of the balance sheet to work with, you can start to delever assets and put more capital toward writing reinsurance business whose rates have increased by 10 or 20 or 50%, and in some cases even more than that. And that's exactly what we find occurring with our total return reinsurers, where they have decreased the amount of investments in risky assets and have gone to more traditional investments, and have increased the capital that they've allocated toward writing more reinsurance premiums.
Mm-hmm. Yeah, absolutely.
So what advantages do traditional players still hold over the total return companies?
Yeah, I think that's Steve's answer to the prior question is a great kind of segue into this question as well. I think what in the reinsurance market, what we've really seen is the benefit. We've talked about this in other segments as well. The benefit of those relationships that they've built, and although the theoretical idea of what a total return insurer can be with the asset and the liability side both working, I think insurers themselves like to have that long-term relationship, and that's kind of where you run into these issues where you make a partnership with a traditional reinsurer and you have that partnership for a long term, whereas you have that worry with the hedge fund total return type model where it could delever if the market goes south. And that's something I think that insurers are very aware of, and that's kind of worked against the hedge fund total return insurers to this day.
Yeah, and Dan, in addition to that, though, I wonder if we should consider also keeping in mind your comments about forming relationships and understanding that takes time, and seeding companies and reinsurers, walk down a path together over some number of years. The relative short tenure of our total return companies that we rate compared to the traditional reinsurance ratings, where almost all of the total return reinsurers have formed after or during 2012. There's only one that formed prior to that and was formed in 2006. But all the rest of them have a tenure of less than 10 years. And you can imagine that as a startup reinsurer of any ilk, you have to prove yourself in the marketplace. You have to form those relationships. And while both traditional startups and total return startups seek to hire management and underwriters that have connections into the marketplace, they have to be proven in the new format.
Yeah, and I think that's what we've seen with this development of this model, where we've really seen these phase after phase, the corrections, these tiny little things to kind of get them to fix those little discrepancies that kind of separate the traditional model from their model as well.
So AM Best has formed a composite of total return insurers. How is that composite performed compared to AM Best Bermuda composite of reinsurers?
So I'll field that one. From a balance sheet perspective, we expect that there'll be a lot of risk there, but typically these companies are holding a little less leverage on the underwriting side, especially compared to the Bermuda composite. So where we do see some shortcomings are in the operating performance, where there's been a lot of volatility from an ROE perspective and really from an underwriting perspective as well. Doesn't help that, like Steve said, there's a lot of businesses focused around this, casualty type business that has really been a plague in the U.S. market for a couple of years now. Social inflation has been running rampant, and I think that's kind of exacerbated the issues with the volatility. But the investment, as you expect, the investment income's been pretty favorable throughout the years. It's just that underlying volatility that's been an issue.
Yeah, and then, it's an interesting question when you start to do an actual analysis. I think you're 100% right. So total return companies, not surprisingly, started out with a casualty bent. And the main reason for that, in our view, is that you get to hold the money in the form of reserve leverage, i.e. float, that you can invest for 2 or 3 or 4 or 5 years versus going out and writing property cat, which consumes a lot of capital, number one. And then number two, also is a very short claim tail. So you're not really holding the reserve money for that long. But there's another factor here that also talks to the relatively short tenure, whereas a lot of the traditional reinsurers, particularly Bermudians, have built up quite a substantial reserve redundancy over time that they've been taking down for at least the last few years, that has acted from a calendar year combined ratio perspective to inure to their benefit. Well, if you started a company in 2012 and you started in a casualty bent, as you specifically pointed out, developmental things like social inflation, the total return companies have not been able to avail themselves of the 3 to 6 points annually that would be reflected in their combined ratio if they had had a longer tenure and had the reserve redundancies built into the reserve base, i.e. the float that they could take advantage of.
Mm-hmm.
So how do you think these reinsurers will manage through the pandemic and beyond that improve operating results?
So I'll start with this one, and we'll let Dan kick in his thoughts. But we expect them to meander their way through the pandemic in a way that we would expect any rated reinsurer to. There are some advantages and disadvantages. One of the disadvantages is the relatively small balance sheet size, number one. And number two, the types of products that they have written may leave themselves exposed to outsized pandemic-based risks. Having said that, what we're talking about here is the concept of third and fourth party liability more than the business interruption property issues that we see more traditional property cat types of coverages experiencing. All of these things will be borne out in the courts over the next few years. But certainly AM Best's view is, and the industry view is, that those items were not covered in the underlying policies, and that if courts start to undo contract law, that's a bigger problem than a few years worth of earnings diminution. Moving forward, though, that the strength that a total return company has is because of the volatility that you can get on both sides of the balance sheet at one time, they generally hold on a risk-adjusted basis more capital, i.e. relatively higher BACAR scores. And so that will help them disintermediate what is their small balance sheet size to some extent, but there is a maximum with which they will start to suffer. So, maybe in conclusion, they're exposed to the same things that everybody else is. They are risk managing their way through the process like everybody else is, all the other traditional reinsurers. And really these macro issues, as they're decided in the court system, are what will weigh on all reinsurers. Another distinct potential disadvantage that these reinsurers have is they are still susceptible to volatility in risky assets. And fortuitously or not, a lot of these total return reinsurers have decreased the amount of assets they have invested in risky assets, moving more toward traditional items in 2019. But they still do have an overweighting even after that move in risky assets. And if there's a double dip into the marketplace, so far things have been rip-roaring in the stock market. Credit spreads have tightened significantly on non-investment grade bonds, pretty much everything except levered loans, I guess, at this point. And so there's been a significant recovery from the balance sheet issues that were experienced from the asset side of the balance sheet that were exacerbated in total return companies, as you can imagine, compared to traditional reinsurers.
Yeah, and I would just add, I think the whole reinsurance sector, when we're looking at, you're coming into a market that's really going to have some pricing momentum for, a couple of years in a row now, for the first time in a while. So I think when most of these were established, much different environment. We're walking into an environment now with some pricing, so the pricing's improving. The investment things could go either way. It's been good so far. It could go the opposite way. So there's always some uncertainty, like Steve said, especially with the casualty business, that the courts might end up treating some of these things differently than we would expect. But it's an ever evolving cycle. I mean, in the process of writing this, Third Point and Sirius joined together to, bring the Sirius Point. So I think all of these insurers are kind of revisiting their models and improving it in ways that they can. We'd expect that with the market dynamics to be some improvement, but there's always some uncertainty in the insurance industry.
Well, Dan and Steve, thank you so much for speaking with us today.
Thank you.
Goodbye.
To view the full report, visit aminvest.com. For AM Best TV, I'm Meg Green.